Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button.
hmm
Now let's break down what's happening in the markets today in a clear and simple way. So, we are currently looking at a U.S. 10-year Treasury yield that recently neared 4.6%.
Yeah, approaching a one-year high, actually.
Right. And we are seeing the average borrowing cost across the G7 nations jumping from roughly 3.2%, which is where it was before the current geopolitical conflicts, up to nearly 4%.
Which is massive. I mean, these are yield levels that the global financial system has rarely seen since, like, 2007.
Exactly. And for decades, everyday Americans have been taught this one simple, unshakable rule of investing. Stocks are for growth and they carry the risk, while government bonds are for safety.
Right, the classic bedrock of the financial system.
But according to recent analysis, that fundamental rule is just completely breaking down right before our eyes.
It really is. The data is showing this massive global repricing of what a safe haven asset actually is. It's not just a temporary delay in interest rate cuts. It is a structural shift.
And it's a shift big enough to actively threaten the economic strategy of President Trump's administration, right?
Oh, absolutely. And it filters all the way down to the individual. It directly impacts your ability to buy a home or even value your tech stocks.
So this deep dive is all about understanding why that old, reliable bedrock, the U.S. Treasury bond, is suddenly giving investors whiplash. Let's start with the traditional playbook. I like to think of the classic 60-40 portfolio like a balanced diet.
Okay, I like where this is going.
So stocks are the high-energy carbs, right? They give you the growth and the fuel. And bonds are the healthy vegetables that keep you grounded when the sugar rush crashes.
That's a great analogy.
But the question we have to ask today is, well, what happens when the vegetables start making you sick too?
Right, exactly. And to understand why that's happening, we have to look at how things used to work. Historically, if the stock market got shaky or the economy slowed down, money would just flood into bonds.
Because people wanted safety.
Exactly. And because everyone wanted to buy bonds, the price went up, which drove the yields or the interest rates they pay out down. So lower borrowing costs naturally stabilize the economy.
It was basically an automatic risk-off asset.
Yeah, but today, that's completely broken. Due to the ongoing Iran war and the closure of the Strait of Hormuz, we're seeing massive energy supply shock.
Oh, right. Because oil and transport costs just skyrocket.
Exactly. Which means inflation is sitting stubbornly above the Fed's target. Because of this sticky inflation and, well, fiscal instability, both stocks and bonds are being pressured at the exact same time.
So the vegetables are definitely making it sick.
Yeah, bonds are just no longer an automatic safe haven. The old rule of slowing economy equals lower rates is officially dead.
Wow. Okay, so if the old rule is broken, what are the new forces actually driving the market right now? How do we make sense of this?
Well, the recent data points to four main pillars that are dictating this new bond reality. The first one, like we just touched on, is revived inflation.
Right, the Middle East conflict's pushing up energy and commodity costs.
Exactly. The second pillar is supply overload.
Okay, what does that mean in plain English?
It basically means the U.S. government is running massive deficits. They are issuing a mountain of new debt to cover spending and soaring interest costs. But central banks aren't stepping in to buy it all up anymore.
Oh, so everyday private investors have to absorb all that debt.
Exactly. There's an oversupply, which forces yields higher to attract buyers. Now, the third pillar is something highlighted by the Federal Reserve Bank of San Francisco, which is the return of the term premium.
Okay, wait, term premium, I want to zero in on that for a second because that just sounds like dense Wall Street jargon.
It kind of is, yeah.
If I'm translating this for a beginner, is term premium basically just hazard pay?
Oh, I love that. Yes, hazard pay is the perfect way to describe it.
Like if I'm going to lend the government my money for 10 to 30 years in a highly unpredictable world, I want extra hazard pay to do it right.
Exactly. It's not just about what the Fed's policy rate is today. Investors are demanding higher compensation for holding long-term debt because, inflation is sticky, debt is piling up, and political pressure is rising.
Right. They want to be paid for the hazard of the unknown.
Exactly. And that brings us to the fourth pillar, which is shaken policy trust. A March 2026 report from the Bank of Canada warned that market concerns over how much government debt can actually be absorbed is driving yields up globally.
Wait, really? The Bank of Canada is warning about global debt absorption.
Yeah, because investors are starting to question the sheer math of it all. When trust in fiscal policy fades, people demand even more of that hazard pay we just talked about.
Man, it's so easy to view bond markets as just like high-level Wall Street math. But this hazard pay connects directly to the listener's everyday life, doesn't it?
Oh, completely. It dictates the cost of almost everything.
Yeah, let's talk about Main Street impact. According to a May 20th report from Reuters, the U.S. 30-year fixed mortgage rate hit 6.56%, which was a 7-week high at the time.
Right.
And mortgage applications immediately dragged by 2.3%. So higher bond yields directly equal more expensive housing.
Exactly. The mortgage rate is mechanically tied to the 10-year Treasury yield. When the bond market demands hazard pay, your local bank demands hazard pay for your house.
But let me play the role of the everyday listener for a second. If I'm just a regular person looking to buy a house in Ohio, why on earth do I need to care what a Japanese bond investor is doing on the other side of the planet?
That is the million-dollar question. And the answer is that the bond market is one giant interconnected global web. International borders don't protect us from these shifts.
Right, because money just flows to wherever it gets the best return.
Exactly. Let's look at Japan. Their yields are hitting levels not seen since the 1990s.
Oh, wow, the 90s.
Yeah. And historically, Japanese investors bought a ton of U.S. debt because their domestic interest rates were practically zero. But if Japan's interest rates rise, those investors will just keep their money at home instead.
Oh, I see. So there's suddenly less demand for U.S. debt.
Exactly. And less demand means the U.S. has to offer even higher rates to attract buyers, which, like a domino effect, directly pushes up the cost of that 30-year mortgage in Ohio.
That is crazy to think about. Your local real estate market is totally at the mercy of global bond flows.
It really is. And we saw a similar thing in the UK recently. Their bond yields reached highs not seen since 2008 due to fiscal and political worries.
Right.
Though it is worth noting they saw a brief temporary dip down to 4.99% on May 20th.
And that was just because their April CPI came in slightly lower than expected at 2.8%, right?
Exactly. One tiny decimal point in an inflation report sent massive ripples through the market. It just shows how fragile the whole system is right now.
So if the old rules are dead and the global WEG is this fragile, how should a beginner investor actually protect their money today? I mean, what is the new investment playbook?
Well, the first thing to realize is that long-term U.S. Treasuries are now a dual-edged asset.
Dual-edged how?
Well, the absolute yield is super tempting. I mean, the 10-year is around 4.5 to 4.7%, and the 30-year is over 5%.
Wait a second, let me play devil's advocate here. A 30-year U.S. government bond paying over 5%. That sounds amazing. Why shouldn't I just put all my savings in there, lock in that 5%, and go to sleep for 3 decades?
I mean, on paper it sounds great, but the danger is the price volatility. Because of that rising term premium, the hazard pay locking in right now is incredibly dangerous.
Why is it dangerous if the return is guaranteed?
Because if you buy a 30-year bond and rates keep climbing due to inflation or government supply issues, the underlying value of your bond could plummet.
Oh, right, the seesaw effect.
Exactly. If new bonds are paying 7%, nobody wants to buy your old bond paying 5% unless you sell it at a massive discount. You could take a huge capital loss.
So they present themselves as safe, but the duration risk is huge.
Right. Which is why analysts advise moving away from relying solely on long-term bonds for defense. You need a multi-layered defense now.
Okay, so what goes into that multi-layered defense?
You want to focus on short-term bonds, and especially midterm bonds like the 5 to 10-year range. That's a much safer balance for yield without the 30-year trap.
That makes a lot of sense. You get the yield, but you aren't locked in for a generation.
Exactly. You should also look at TIPS, which are Treasury inflation-protected securities to guard against inflation, and a lot of investors are using gold as a final layer of defense.
Okay, so that covers the defense. But what about the offense? What about the stock market? Because rising long-term rates have to act as a gravity pull on stocks, right?
Oh, absolutely. Especially for AI, big tech, and growth stocks.
Because the era of free money is over.
Exactly. In the past, companies could just sell investors on future growth promises. But today, AI companies must prove they can handle massive capital expenditures, or CapEx, and still generate free cash flow.
So they can't just run on hype anymore. They need actual present-day cash flows.
Right. Stock investors need to focus on companies with high ROIC, which stands for Return on Invested Capital. You want strong present-day cash flows rather than distant promises.
It's like demanding that the factory is actually efficient today, not just hoping it will be in 10 years.
That is exactly it.
Well, let's briefly recap the main takeaway here because this has been a lot to process. The current market chaos, the mortgage rates, the tech stock rotations, it's not just a temporary delay in rate cuts.
No, not at all.
It is a fundamental structural repricing of what a safe haven asset actually is. Bonds still matter, absolutely, but you have to be much more strategic about which ones you hold and why.
Exactly right. You can't just blindly buy and hold anymore.
Which leads us with the final kind of lingering question to ponder. If the ultimate safe asset, the U.S. Treasury, is no longer unconditionally safe, how will this completely reshape the psychology of the next generation of investors who have never actually experienced the world without a guaranteed financial safety net?
That is a fascinating question. It's going to require a totally new mindset.
It really is a whole different ballgame. Don't forget to subscribe and hit that like button.